Live. Welcome to another Sunday Night Futures Live. What we're going to be talking about tonight is, of course, the opening price action of the futures and the bond market, commodity markets, etc. We're also going to spend some time talking about what the hell is going on. Why do we have so many power plays being played on the population of not just the United States but on the globe? And I did a lot of time this weekend as I come off of my opioid riddled overload over the past several weeks or several days. And I spent some time doing research. And what I found was pretty profound. We're going to try to talk a little bit about that. I'm going to give you the answer of where I want to go with this in advance of me going into the details of why. So that way you're not trying to figure out what the hell is he trying to put together here and being lost. So it could get a little bit wonky. Then I want to talk about what a bottom looks like. I want to go back to prior bottoms, 2008, 2020. I want to take a look at those bottoms relative to how we're looking at this point in time. And have you seen a bottom? Can we draw a conclusion at this time? And of course, we're going to take some chart requests. And first off, what we're going to do is we're going to say hello to people and let's get to it. Seymour Rivers. Good to see you, Bob. The audio is very good. Thank you, Seymour Rivers. Appreciate that. Always my top producer. Trader Isaac. I am feeling better. Trader Isaac, yeah. I had a hematoma, a huge, massive hematoma that made my leg about 3 times the size of what it's supposed to be. And it was a lot of pain, but yeah, it came down a lot. Still there, but you expect that after surgery. So a lot better. Thank you very much. And looking forward to a speedy recovery. Luis. Hola, Roberto. Hola, Luis. Buenos noches. Good evening to you, mi amigo, my friend as well. ¿Cómo está usted? I don't know siente. What's siente? ¿Cómo se siente? You got me on that one. You got to educate me, Luis. I did okay up until that point. You stumped me. What are we looking here? We're looking at the S&P 500. Sorry about that. I should have said that. S&P 500 is what we're starting out with. We're going to let this settle out. This is a 15-minute chart. You're looking at 3 screens. Oh, hold on. What are you looking at? I see. Hold on. Thank you. Thank you very, very much for that. Let's do this again. I had the wrong screen up. Thank you very much for that, Trader Isaac. I see. How are you feeling? Feeling a lot better. Really no need so far for the painkillers, the opioids. So feeling a lot better. Thank you very much. Don't fear the stairs, Bob. It just takes a step by step. You can do it. Yeah, I finally got up the stairs the other day. It was kind of a big deal. I'm still taking it really easy with this type of surgery. It's not even my age per se. It's a matter of if you don't take it very, very carefully in the early stages, meaning keeping pressure off of the muscle, the surgery could fail. My brother's an orthopedic surgeon, and when my doctor said that to me, I was kind of ticked off because he was seeming negative. And I called my brother, and he says, he's actually right. So just take it very, very easily. And that's what I'm going to do. I should be back at full force, back in the gym by January 1, but I'll be back in the gym, no pressure or a little pressure on the hip by probably in about another 2 weeks or so. But with machines that take your feet actually off the ground. They have special machines there at my gym, so I'm lucky. All right. Let's get to it. Let's talk about the futures action here. So before we get into this, I want to put things into context of what we're looking at. Now, one could argue, because usually I start off Sunday night futures, if I see the futures up and we're in a bear market, I usually begin with, don't get too excited here. I still wouldn't get too excited per se. And the only reason why I'm trying to recenter and put things in context more so is because we had that rally on Thursday, right? That was a big reversal bar. And while it doesn't guarantee that we put a bottom in, you wouldn't be the least bit surprised taking a look in your rear view mirror that, okay, we pulled back, we tested the lows off of that Thursday low, and we moved higher to put in higher highs. Okay, we have a bear market rally. So you wouldn't be surprised to see that. Nobody would be in shock. But we're going to talk about whether or not we can definitively draw that conclusion vis-a-vis bear market bottoms back in 2008 and 2020, as I spoke about earlier. So I wanted to recenter, just reminding people that we had that Thursday bottom potential. Hello, Bob. Hope you're recovering well. I am. Thank you very much, TZ Burton. A lot better than I was, even on Thursday night. Thursday night, I was looping. Okay, so let's talk about the E-minis. They are up fractionally, up 0.16%. We have a 15-minute outside reversal bar. They just got spiked up. A large order just went through. Let's drill down here. So we appear to be gaining some momentum here. I'm just going to set an alert for just in case we reverse and break to new lower lows. Because remember that on Friday, we closed out the week right at the lows of the week. So we don't want to see new daily lower lows. SPY. Okay. Now moving on to, let's stick with equities first. NASDAQ looking really good here. The NASDAQ, when I first brought the screen up, it was up spot 42%. It's dipped down a little bit to spot 37%. So we're hovering over a third of a percentage point move up higher. This is a 5-minute chart. Let's get off of this. It's a little bit too wonky, too noisy. Another outside reversal bar. Remember that Friday's price action was pretty much a no-tick up day, or down day, I should say. I mean, it was really an overall bore of a day. Volume rose. It didn't feel like a heavy bar, but volume bar day. But by the end of the day, it was pretty solid to the downside, and there were no upticks, except obviously here at the open, and then we faded all throughout the day. In fact, on several of the indexes, we put in new daily higher highs. The Russell 2000. The Russell 2000 is up spot 37%, consistent with the NASDAQ. Let's move on over to bonds for a moment. And then we'll take a look at look at this. Look at this. So we have the 10-year Treasury note. Now you know why we have equities moving up high, strong at the open, is because we have the 10-year Treasury note that is moving up higher here, gapping up. It's already filled the gap. And what that's doing is, I screwed that up. It's forcing yields down. Now, why is that important? Especially causing the NASDAQ to spike up higher along with the small caps. The reason is that, remember that we spent and closed out the day and the week and the month and the week last week at a 4 handle. We had a 4 handle on the 10-year yield closing basis for the first time since, I think, was it 2008, something like that? Uh, 2018, I believe. So we'll see whether or not this has legs. If this continues, if we see a pullback on yields, that will allow equities to rally up higher. Let's take a look at the yields. Here you can see it. Here's the 10-year. Let's bring this onto the big chart. Okay, so you can see back here, we were to four handle back last Thursday, but this was in the pre-market session. You'll note that by the time the markets had opened for the regular hours session, we were back down below a four handle. So we closed out the week above a four handle. So the question is, are we putting in a double top? Way too early to make that call. But certainly the close above a four handle, especially on technology stocks, weighed very, very heavily and is no bueno. Let's move on over and take a look at the US dollar. The dollar gapping down. That is good. I'm going to put an alert right down below this support level here. And I would like to see it break support. Now, moving on from the dollar into the commodity space, take a look at gold. Gold is just horrible, horrible on technicals. We're up fractionally here, but I wanna pound the table on gold, but I can't. I just simply can't. Not with the dollar this strong. We need to see a break of the US dollar. Now, the upside here to the dollar, and the fact, let's bring it up. And it may kind of make me a liar, apparently, but I'm going to make the call anyway. At least in the regular hours session last week, we did not put in a new weekly higher high. We have done it perhaps on the Dixie did close at a higher high last week. Maybe it was the UUP I was looking at. I could have sworn the dollar did not put in a new higher high last week. It did. It did. I stand corrected. I stand corrected. It was probably what I was looking at. It was the monthly chart. And obviously, yeah, we haven't put in a new monthly higher high. Okay, now it makes sense. All right, so the dollar did put in fact, a new weekly higher high last week. And in fact, what it did do is it broke out above this upper band of resistance. This weekly chart is not for this week. It's for last week. This is not reflecting current price action. So the dollar remains very, very strong. Back to a 15-minute chart. So a quick peek at the yen, gapping up here, but it's an absolute basket case. The euro, which is far less worse than what is the Japanese yen. Now, remember, these two currencies, the largest components versus the dollar Dixie basket. So this basket here, the DXY, is weak when the Japanese yen and the euro, in particular the euro, are strong. Oil moving up higher, just shy of a third of a percentage point. Let's go to home heating. I just got another fill up the other day. Thank God I did. Wow, look at this. Sticker shock with my home heating oil bill. Home heating oil up 1.25%. It was shocking how expensive it was. And normally when I get a bigger delivery, they give me a discount, right? This time it didn't matter. The discount was like a penny. It was really no big deal. So they're feeling it. They're freaking out. Natural gas prices. Now, we're going to talk about this in a moment. There is a cold front. I can't believe we're gapping down right now. 3% on natty gas. There's a major storm front moving in, a cold front, I should say, over the entire North American continent. So I'm very surprised to see that natural gas is gapping down like this. It's early. We'll see whether or not we do rally back and fill this gap. Silver. Silver catching a bid up over a percentage point. Good stuff. Silver is cheap as heck. Corn price. Let's take a look at this on a weekly time frame. Corn drifting upward. Soybeans, they broke down 3 weeks ago, attempting to rally back, recapture support. This may fail. This is a classic breakdown, attempted recapture, and we may break down here on soybeans. And that's a good thing. Wheat also had broken out here, actually here, failed here, broke out here, failed yet again last week. Again, this is not this current week so far. This is last week's price action on a weekly time frame. So ag prices are taking it on the chin in certain areas. And I think that is it. Did I miss anything? Let's go to the major chart. VIX, lower right here, weak. Attempting to mount a comeback, but this is a horrible outside reversal bar. First 15 minutes of trade. Dollar trying to mount the comeback as well. 10-year yield we spoke about, fairly weak on the session, but still holding a four handle. What we want to see is a break to new lower lows on 10-year yield. Okay. Do some comments. Hey, Tom, thank you very much. Appreciate it. Hello to you too. Is our government engaging in a currency war? I'm going to talk about that in a moment, Jeff. Seems like there's no bottom in sight with a strong dollar. I'm going to talk about it. It's a great question. It's a very, very, very timely question. The 10-year over 4.2% and need PPT to get it below 4%. I saw an article out about them the other day. Like, a plunge protection team, are they back? Bob thinks Dixie 120 current. What did I say? I didn't say it was 120, did I? Did I say it was 120? I don't think I did. If I did, I blame the effects of the opioids. Okay. What else do we have here? Clark. Hey, Bob, I think so long has been a best horse in the glue factory, U.S. dollar weakness. I think that we rally. Yeah, little doubt about that. We need the dollar to roll over. NG pulling down. Yeah, 3%. Okay. Falcon. Hey, Falcon. Welcome. Okay, if I could ask everybody, please smash the like button and subscribe. You know the deal. All right, let's talk about economic data coming out this week real quick. I mean, it's earnings season. It's beginning in earnest now. So I'm not going to spend too much time on this because what I like to call this time of year or this time of the quarter, silly season, economic data takes a backseat to everything. Excuse me. Yeah, it takes a backseat to earnings, I should say. So tomorrow, Empire State Manufacturing Index. Tuesday, industrial production, cap utilization rate. Wednesday, building permits. They came in weak last time around. Housing starts are coming out. Thursday, weekly initial jobless claims. Philly Fed Manufacturing Index, leading economic indicators. I think the Fed pulls that out. And on Friday, inflation expectations 5 to 10 years. I mean, boring. I mean, I don't know how they're going to calculate that. Okay, so that's economic data. I wouldn't focus too much on it because it doesn't matter. It's all about earnings now. Our chiller PE ratio closed out the week last week, 26.82, mean 16.98. Folks, we're still expensive. I know it sounds crazy. After the beating the markets have taken, we're still expensive. The Buffett indicator, we remain fairly valued. We are at the lows of, since I've started doing this Sunday night presentation, current ratio of 150 is approximately 18% or 0.6 standard deviations above historical trend. Now, remember, that may give you the warm and fuzzies that, okay, we're only 18% above the historical trend line. I mean, at the peak of when I started doing this, we were 2 standard deviations beyond up here relative to historical trend. The thing to keep in mind is that as the pendulum is swung to the overvalued levels, usually when you get to a bear market bottom, the pendulum swings to very oversold or very underpriced equities. So if we hit historical trend, I don't know what that means really. Does that mean the end of a bear market? I don't think so. I think that we need to have capitulation. Capitulation will drive you down and below the historical trend, ideally to a 1 standard deviation, 1.5 standard deviation, just like we saw back in 2008, back in 2000, 2001. In that neighborhood, equities were undervalued, and that allowed for, along with the Federal Reserve, for equities to begin the next leg up. We're not there yet. Earnings this week. So we did earnings last week. We had a really good trade with BlackRock. We made money on JP Morgan, but very little. It was just basically a scratch. This week we have Goldman Sachs coming up. I may play that. The way that we'll trade earnings is going to be with options using Strangles. And that's the sale, not the purchase of the options. And Lockheed Martin, we traded last quarter. We did very, very well with that. On Tuesday evening, Netflix, folks, I'm going to talk a little bit about Netflix earnings in a moment. They're expecting a roughly $24 anticipated market maker move. That should only be your bare minimum expectation of how much that stock can move. So I've traded Netflix many times on earnings, and I've seen it go 3 standard deviations, meaning 4, 5 times the anticipated market maker move. So be very, very careful about Netflix and trading earnings. Be very, very small and be conservative. I beg of you. IBM coming up. We have Tesla coming up this week. Alcoa, I usually don't trade into earnings. Blackstone, I don't trade. Snap, I don't trade. I don't trade those types of stocks. Amex, very little in terms of premium that I would receive. So I probably won't be trading Amex unless their implied volatility is very, very high. So we'll price it out. But The names that we're looking at to trade on earnings this week, definitely Goldman Sachs, Lockheed Martin. Lockheed Martin's a very expensive stock in dollar terms. So I may not be able to do both, but it's going to be one or two of both, but a much smaller position on Lockheed versus Goldman Sachs if we trade both. IBM, I don't know if I mentioned that. And of course, Tesla, we will be trading. Now, I follow Carter Worth. He's a pretty good technician. Worth charting.com if you want to follow him. He's on Twitter. And he put out a couple of charts on Netflix and Tesla. And I think they're pretty interesting. And I agree wholeheartedly with him on the Tesla chart. And while I agree with him to a certain extent on the Netflix chart that we might break out here, we haven't broken out yet, unlike Tesla, which has broken down, right? So we haven't broken out yet on Netflix. So be very, very careful. And I say that because when you take a look, I thought I had this up here. When you take a look at Netflix, on a daily time frame, it's kind of misleading. You know, it's held up very, very well relative to the rest of the market. It's showing relative strength versus the S&P, versus the Qs, versus the Nasdaq, etc. It was down on Friday. No great shock. Everything else was too. Up strong on Thursday. Nice reversal bar on Wednesday. So Netflix has been showing really, really good relative strength. Now, where I take a little bit of issue with the implied bullishness, I'm not saying he's bullish, but the implied bullishness of Carter Worth here is that on a weekly time frame, we had a breakout the week of the 26th. That breakout failed the week of October the 3rd with a bearish reversal bar. 240 is very stiff resistance, and then after that is 250. So to think that on a disappointing earnings report, we couldn't break this support level is not out of the realm of possibility. And if we break 214.69, we could be heading down to $200 per share in a heartbeat. So long story short, be very, very careful. And when you take a look at the monthly chart of Netflix, one could argue that what you're doing here is setting up for a bear flag setup. I'm not saying it's going to do that. I'm completely 50-50 on this stock right now. Now, when you take a look at the stochastics, a rollover down below 20 would be a disaster. A rally up and through 20 would be very, very significant. So we are at an inflection point on Netflix. So don't get lured into a false sense of security that all is right with the world with Netflix, because again, we are at historical resistance. And that last historical data point where we could find resistance can go back to right back here, January of 2019. We remain below that resistance level. We're fighting to get through it. A lot of overhead supply. Be careful. There were a lot of people during this earnings report. This all happened in one day. This sell-off here happened in one day, post-earnings. I was in it. Believe me, I know. So please, the only reason why I'm spending so much time on this chart right now, I don't want you to get hurt. So beware of the upgrades before the announcement. Beware of the talking heads on CNBC to buy the stock or short. They're not going to say short the stock. Buy the stock in advance of earnings. If they tell you that, they're absolutely corrupt and incompetent and nefarious. So please don't do it. Okay. I want to talk a little bit about the environment that we're in. And I spent a lot of time this weekend thinking about it. And there's a war going on. It's an economic war. It's a war. I forgot who said it. I believe it was Jeff who said it earlier. I want to give credit where credit is due. About the US dollar. I forget who said it. I'm trying to go through the I can't find it. Too many comments in here. I don't want to waste time. But there was a comment with regard to the US dollar and basically currency wars. Come on, Bob. We all watch Fox Business, not CNBC. Good for you. Charles Payne. I love Charles Payne. Nice guy. There is a currency war going on, right? So what we're dealing with here, you have two factions, right? It's a global war. You have two factions. One is political. The other is the central banks, right? The political faction, they're very, very corrupt. They've been living off of a credit card for generations now. And going back 40 years, since the end of the last round of stagflation, where the politicians just had to say to the Federal Reserve, kill inflation. We don't care about the political consequences. When have you ever heard them say that before? They had to stop it. And from there, out of the ashes grew a phoenix of a brand new economy. You had the Reagan administration, and all was right with the world. Bond yields went into a 40-year decline. Dollar declined along with it, and manufacturing went overseas, and prices went down. You had a deflationary spiral. That is all changing now. It's all changing. So when it changes and parties need to can maintain control, yet they don't have the money to do it with anymore, they turn authoritarian. And what you're seeing happen right now is that you're seeing the rats fleeing the vessel. Those rats that are not big enough to be protected, they are fleeing the vessel. And I always go back to this quote after each bubble, but this time it's political. This bubble is political. It is Washington, D.C. based. You never know who's swimming naked until the tide goes out. Warren Buffett. And keep that in mind as we go through this. And you see the nefarious behavior of what has been going on since really in earnest since the Obama administration. And you could argue, you want to go back to the Bush administration when the war in Iraq. Okay, I'll go with you. Let's not make this political. A pox on both political parties' houses here. And if we could do that, if we could find that common ground, we avoid drawing conclusions that I'm a right winger and I can't stand the left. You know, I'm middle ground. You know, I want my kids to grow up in a better place than where I grew up. You know, and it doesn't look likely for many people, and it makes me very, very sad. So let's look at it from a position of doing well for your children, because what's not being done well for your children is the level of absolute and utter criminality that is going on. If you want to begin with, again, the invasion of Iraq, weapons of mass destruction that were never found, but Americans killed. The defense contractors did very, very well. And they always do very, very well. You harken back to Eisenhower. President Eisenhower's last warning to the American public was, beware the military-industrial complex. I didn't make that up. I wasn't even born. So you fast forward to present day, and you have testimony that was given. Pfizer confirms mRNA vaccine never tested for preventing COVID transmission. Okay, I'm going to read that again. Pfizer confirms mRNA vaccine never tested for preventing COVID transmission. But weren't we told by the President of the United States that the COVID vaccine was a disease of the unvaccinated? Weren't we told by the President of the United States that if you got the shot, you would avoid getting COVID? And now what we're hearing is this. If you don't know this piece of human garbage, this is the CEO of Pfizer. And let's just walk you through this timeline.
A lot of indications right now that are telling us that there is a protection against transmission of the disease. There is no variant that we have identified that escapes the protection of our vaccine.
Against COVID to come now with a treatment of 90% effectiveness, personally makes me very proud about
And we know that the 2 doses of the vaccine offer very limited protection, if any. The 3 doses with a booster, they offer reasonable protection against.
It is necessary a 4th boost right now. The protection that you are getting from the 3rd, it is good enough, actually quite good for hospitalizations and deaths. It's not that good against infections, but doesn't last.
A lot of indications right now that are telling us that there is a protection against transmission of the disease. There is no variant that we have identified that escapes the protection of our vaccine.
Against COVID to come now with a treatment of 90% effectiveness, personally makes me very proud about
And we know that the 2 doses of the vaccine offer very limited protection, if any. The 3 doses with a booster, they offer reasonable protection against.
It is necessary a 4th boost right now. The protection that you are getting from the 3rd, it is good enough, actually quite good for hospitalizations and deaths. It's not that.
All right, I think you get the picture. I want to go back to this. Pfizer confirms mRNA vaccine never tested for preventing COVID transmission. This was from October the 12th. And we're not going to get into a debate about the efficacy of the shot. I'm not going there. I don't want to talk about it. It's a highly, highly, and understandably hypersensitive topic, and I will not go there. So the question becomes, why is it that you had the president of the United States sign off on contracts? And this is not Biden. This is not Biden. Why is it that you had the United States government, whoever signed off on those contracts, why were they so adamant? And this was not Trump that did the mandates, but why were they so adamant about everybody getting vaccinated? Why did Biden mandate that everyone get vaccinated and kick people out of the armed forces, Navy SEALs out of the armed forces? Royalty payments to staff researchers cause new NIH troubles. The press agency has reported that 916 present and former NIH researchers, this is the U.S. National Institute of Health, I should have said that, received royalty payments averaging $9,700, but could receive as much as $150,000. I went up here on Fauci, but apparently I'm out of sequence here. Fauci disclosures show Dr. Fauci's household made $1.7 million in 2020, including income fees off of travel perks and investment gains. So where am I going with this? What does this have to do with the stock market? Well, the corruption is just mind-blowing. And it's out in the open now. The mandates, that was about control, about controlling people, about controlling the economy. And that is where we are moving to now, because what's happening over at the Federal Reserve should be disturbing to a lot of people. Fed's net, this was not reported very widely. Fed's net income turned negative in September, but it was no surprise. Yeah, right. Here's the problem. And Jay Powell is going to have a lot of problems on his hand once he goes up to Congress. In recent years, the money handed back to the Treasury. Remember, when the Federal Reserve has excess net income, that must be remitted to the U.S. Treasury. Recent years, money has been handed back to the Treasury was substantial. The Federal transferred back $109 billion for 2021, the central bank said in March. That was well over the $86.9 billion in so-called remittances handed back in 2020. Now, the Federal Reserve is now, they're not making money as they were. I guess they're covering their expenses, but there's no net income. And they're going to have to go back to Congress. I had this highlighted before. I don't know what happened to my highlights. And they're going to have to say that, you know, we're going to continue raising interest rates. It's going to kill the economy. And by the way, we're not paying you anymore. So I want to point this out before I go into this next article, because this all has to do with a shift. I mentioned earlier, we're moving away from Federal Reserve control of the economy to government control of the economy, the authoritarian, the centralized control of the economy. If you're wondering why is all of this mania, this fractioning of the public, meaning victimhood. You're in this class, you're in this class. It's to keep everybody fighting with each other and avoid them looking at the federal government. They're looking at the federal government now for help, because now they've been labeled a victim. You can get money. If you're a student, you're overdebted in your loans, you can get money. I'll add more to that in a moment. So where we're at current is not unhistorical. Where we're at current is our debt to GDP is in excess of 125% and down. We've actually come down on debt to GDP over the past year. We've been here before, though, and that was back here, post-World War II. Now, post-World War II, we just came through a war. What's the difference between now and then? Well, back in World War II, we had most of the world's gold, literally in the United States, physically in the United States. We wanted that gold so we could send arms overseas to ensure we were going to get paid. We had all of the manufacturing in the globe because most of the other manufacturing had been destroyed. Our workforce was coming home. Women would be able to go home to the home. They would be able to start a middle class, which boomed. Tax rates were measurably higher, but add to that, so were the deductions. Interest rates were a lot higher. So the question became, how do we pay off this debt yet still grow the economy? The way you did that is that you brought you had manufacturing already, so that helped. You allowed for a certain amount of inflation. Inflation was never 2% during this time frame, and you had high tax income to pay down the debt, and it took 1945 to around 1980. So around 35 years to make that happen. A long, I'll be dead before we get down there again. But here we are yet again. The problem is that we have shipped since 1979 when we opened up, it was 1971 we opened up China, 1979, 1982, around there, mid-80s, all of our manufacturing got offshored. We went globalized. Now we're becoming more nationalistic. The globalists are now fighting with the MAGA here in the United States. There's a civil war going on. The globalists that are in charge of Washington, D.C. right now are at war with China. They're at war with Russia. And we're going to go into the provability of that war in a moment. You already know it in the Ukraine. It's already there. So I read this article, and this is the article that got me thinking about talking about what we would talk about this weekend. And the guy's name is Russell Napier. I've read his stuff before, and I enjoyed it, and I thought it was very relevant to what we talk about here. So let's talk about it. Central banks are impotent. Remember, Fed's net income turned negative in September, but it was no surprise. And I'll also remind you, as we talk about this headline here, remember during the COVID sell-off, and I've said this before, that the Federal Reserve would come in and say, yeah, we cut rates by a half basis point. the markets would rip up higher. Following day, 2 days later, they would roll over and blow through the lower lows like a hot knife through butter. That didn't stop until Congress got involved and started spending trillions upon trillions of dollars. And here we are yet again. Many pretend that we're still in the system that we had from 1980 to 2020. 1980, the end of inflation. 2020, COVID. We are not. We are going through fundamental, lasting changes on many levels. According to Napier, financial repression will be the leitmotif. I looked this up. It just means recurring for the next 15 to 20 years. We'll see a boom in capital investment. We'll go to that in a moment. And reindustrialization of the Western economies. Why? Militarily, we are at a crossroads. We have the Chinese building up their military. Our semiconductor industry, where they build the semis, they design them here, but they build them in Taiwan. They build them in Asia. And we need to bring all of that back for national security. Why is this shift happening? The main reason is that our debt levels have simply grown too high. Fed's net income turned negative. Total private public sector debt in the U.S. is at 290% of GDP. It's a whopping 371% in France, 250% in other Western economies. Folks, all this means is that they need to take the money from you and me. They got to get the money. That's why you're going to see central bank digital currencies. They're coming. There's no fighting it. They're going to get rid of cash. No more underground economy. This is what they want. This is why I always say, get on the horn with your congressman. Tell them, we see you. We see you. We know what you want to do. How so? Back in 2008, the world economy was on the brink of a deflationary debt liquidation, where the entire system was at risk of crashing. We've known that for years. We can't stand necessary recessions without fearing a collapse in the system. So the level of debt, private and public, to GDP has to come down. The easiest way to do that is by increasing the growth rate of nominal GDP. That was the way it was back done the decades after World War II. That's why I just shared with you this chart. You see where I'm going here? They need to bring the manufacturing back to the United States. That means there are going to be a lot of areas in the U.S. stock market that do very, very well. Infrastructure build, etc. So there are going to be great, great opportunities, and I want to flesh that out right away. What has triggered this process? The structural argument is that the power to control the creation of money has moved from central banks to governments. By issuing state guarantees, we've seen this in the past, meaning the guarantees on student debt. That's why student debt costs have gone up so high. The government guarantees them. Once you guarantee them, okay, universities just raise their prices. That's inflationary. By issuing state guarantees on bank credit during the COVID crisis, governments have effectively taken over the levels to control creation of money. You mean there is always going to be another emergency? Think about it. The S&L crisis, that was a baby. That was a cakewalk compared to the financial crisis. What do we have? September 11th, the Patriot Act. That gave the government the infrastructure to be able to not look at our enemies, but to look at us. And then, of course, you had COVID with the COVID mandates. So it's going to be one crisis after the other. Fear, 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 fear. That's why they need to keep everybody divided. Don't look at them. They're the cure. They want the government to be the cure. When in actuality, They are the arch emesis. They are the Bond villains. Okay, I'm trying to whittle down what I read here. And given the nominal growth consists of real growth plus inflation, the easiest way to do this is through higher inflation. Yes, engineering a higher nominal GDP. Growth through higher structural level of inflation is proven way to get rid of higher debt levels of debt. So think about it. How did we thrive back here with all of this debt? We grew. We just grew. We outgrew the debt that we had. And then in 1971, we killed the dollar, and that really helped wipe out the debt. So this is, I've said this in the past. I think they're going to have a new target, a 4% target on the Fed's funds rate. Inflation rate, not Fed funds rate. I think that we'll see consumer price inflation settling into a range of between 4 and 6%. Without the energy shock, we would probably already be there. Why 4 or 6%? Because it has to be the level that government can get away with. They can get away with it. They bleed you slowly, like the mafia, right? You owe them money, they bleed you slowly. They don't bleed you right away. Yet at the time, central banks have turned very hawkish in their fight against inflation. How does that square? We today have a disconnect between hawkish rhetoric of central banks and the actions of governments. Monetary policy is trying to hit the brakes hard, meaning the Federal Reserve is trying to fight inflation and preserve the US dollar, while fiscal policy tries to mitigate the effects to rising prices through vast payouts. An example is when German government introduced a 200 billion euro scheme to protect households and inflation from rising energy prices. They're creating a fiscal stimulus at the same time as the ECB is trying to rein in their monetary debt. You see what's going on here? The war is both political and with the central banks. It is through nationalists, through the MAGA, China, Russia, and the globalists out of the World Economic Forum and in Washington, D.C. at current. Who wins? The government. No government is asking for permission from the central bank to introduce loan guarantees. They just do it. You're saying the central banks are powerless. They're impotent. This is a shift of power that cannot be underestimated. Walk us through the play out. I was going to skip through a lot of this. We saw the end game and this process then. We saw the end game before, and that is with the stagflation of the 1970s, when we had inflation and the combination of high unemployment. So the end game of the 1970 style stagflation, but we're not there yet. No, not by a long shot. First comes a seemingly benign part, which is driven by a boom in capital investment and high growth in nominal GDP. Let's pause there. Let's go back to this. Not back to, let's bring this up. It's already begun. I was shocked to see this. Micron to spend up to $100 billion to build a computer chip factory this is upstate New York, my backyard. Shocked. No business has come to New York. The last time a business tried to come to New York, it was a service business, Amazon, and Ocasio-Cortez made sure that she burst that bubble and they left right away. So the point is that we're beginning to see already the shift away from China, away from energy fueling Western Europe, which we protect under our military umbrella. That energy is going to come from us or other friendly nations. Only much later, when we get high inflation and high unemployment, like 1970 style, of misallocated capital manifests in high misery index. Will people vote to change the system? And that's akin to when we had Thatcher and Reagan get elected, and then we went back to a free market economy rather than a controlled one. So what's next for investors? What does this all mean for investors? Avoid government bonds. Investors in government debts are the ones who will be robbed slowly. Within equities, there are sectors that will do very, very well. Looking for those, folks. The great problems we have are energy, climate change, Christ, defense, inequality, Christ, our dependence on China, production from China. That's going to change. Will all be solved by massive investment. They're going to print the money because we don't have it. Gold will also do well once people realize that inflation won't come down to pre-2020 levels, but will settle down between 4 or 6%. The disappointing performance in gold this year is somewhat clouded by the strong U.S. dollar. Very true. Let's move on. So to back up what I was talking about, government involvement in basically thwarting the efforts of the Federal Reserve. California is the 5th largest economy in the world, where it's its own national government. Governor Newsom proposed $18.1 billion inflation relief package. So he's going to print more money to fight inflation. Okay, that's the political versus the central bank. And he didn't go to the central bank to ask if he could. He just did. Social Security benefits increased 2023. They're going to increase 8.7%. Again, chosen sector. I'm not saying it's wrong. It's the right thing to do, but the government is going to spend. What are they going to do? Borrow it. Let's skip this. We're running tight on time. More stimulus out of the UK, even though they're trying to tighten over there. These are just examples. I'm just going to blow through them. Germany, we already spoke about this $200 billion investment. So this is how it's going. Yeah, the central bank is doing one thing, meaning strong fiscal policy or monetary policy, but the fiscal spending side, it's going to be deficit spending all the way. And they're going to try to grow GDP to outgrow the inflation or the debt so they don't have to pay it back. So that's why you don't want to be in bonds. Here, the next fear. Why? COVID's over. Federal government extends COVID-19 public health emergency. Why? Control. It's all about the control. They need the control. They need the fear. If they have the emergency, and this is what kills them. Few getting updated COVID-19 boosters despite White House pleas. Wait till after the election. Mandates will be back, despite what the Supreme Court has to say. It's global government re-engineering. Austin Fitts warns Fed actions are 100% power politics. It's a war. I started off by saying this. It is absolutely true. If you look at the money being pumped out on climate change, green energy, environment, all these things, different new sorts of scams, it depends upon how they inject the money. I'm not going to read all this, but I think you get the drift. They are implementing the going direct reset. The great reset is here, folks. There's no stopping it. Talking about, let's take a look at natural gas without loads. That article that I'm trying to bring up is talking about natural gas. And the cold front that's moving down. Natural gas is still down nearly 3%. I'd be a buyer on this gap down. A big blast is coming down from the north, and natural gas is right at its rising uptrend line. So I think that this is a buying opportunity. If they gap it down tomorrow, I'm probably going to be a buyer of natural gas. Although, to be fair, I highlighted this earlier. Globally, we are feeling better about ourselves and about natural gas storage levels. But I read a few weeks ago, we're still well below trend. So I view this through the scope of skepticism. All right, moving into the new trading week. Some good news here. The new trading week, we are up usually going back to 11 years on, this is the TQQQ. I don't want to use the TQQQ. We're looking to get long the market. And we're going to talk now. I'm probably going to go over the 7 o'clock hour, but that's okay. Why are you not changing on me? QQQ. Oh, I see why. I'm going to have an error message coming up here. QQQ. Here we go. So what we're using is TrendSpider, 35% discount code for automated technical analysis. And you do get the seasonality function as well. Okay, so QQQ going back 11 years, up 70% of the time for this upcoming week. We know that November is historically one of the best months out of the year. Taking a look at the SPY. I keep doing that. It is up also 70% of the time, and it only gets better the following week, up 80% of the time. So we're heading into now the end of October, seasonally an okay month, even though you have a lot of crashes that happen in October. But November, seasonally very, very strong, and we're heading into those weeks that become seasonally favorable. So let's talk about bottoms and what they look like. What we're looking at here is the chart of the bottom that was put in back in 2008. So I have this filtered out from August 1, 2008 to June of 2009. And this is what a true bottom looks like. Now, before we go into this chart, let's take a look at how we looked last week. So we have a frame of reference, because remember that Thursday, right? I always talked about it's a bottom when you get a bloodbath in the morning and you reverse to close higher on the day, right? So we had that on Thursday, and I came on Thursday night. I said, oh, this is pretty good. I think we're going to pull back. But if we pull back and rally and we close strong, I think that's very, very bullish. So here you have it. Thursday, a beautiful, beautiful outside reversal bar. If you're not familiar with what an outside reversal bar is or a bullish engulfing, down below I have a five-part video tutorial. My top 5 favorite candlestick patterns, free, link below. So outside reversal bar, and forget about Friday for now, okay? Would I be shocked if we took out the lows of Thursday? No, I would not be, because we're in a bear market. That's what happens. You get bear market rallies, and bear market rallies fail. So let's go back to 2008. So that chart that we saw last Friday, that price action that we saw, was very bullish, equally as bullish as this bar here, a bullish key reversal bar, this bar here, a bullish key reversal bar, this bar here, a bullish key reversal bar. What all of these had in common up until this bullish key reversal bar is that they all looked gorgeous, except the market said, It's like Charlie Brown trying to kick the football and Lucy pulling the ball away. And that's what bear markets are like. So that's why I always try to take a neutral stance in a bear market. Stay far away. Sell premium. If you have a directional play you want to set up, it's looking good. Okay, take it. The long or short side, just don't stay too long. So where we finally bottomed out was here. What made this different from last Thursday? Time. What else made it different was this. It's very, very simple. What we're looking for here are higher lows. That's why I'm saying forget about Friday's price action. It was a bloody day on Friday. Does that mean that we're going to fail? Not necessarily. Does that mean that we're putting in a higher low? I don't know. I'm not that smart. As long as you stay humble and not try to guess the bottom, you're going to be okay. As long as you keep 50% of your net liquidity in cash, you're going to be okay. So What do I mean by a higher low? So we were in this downtrend channel, right? We took out the lows from back here, the lows of October the 24th, 2008, and they just flushed the toilet, right? Because you had a lot of stop loss orders down there. So they flushed it out. This was the capitulation. We rallied down and below the 2 standard deviation Bollinger Band in green, came very close to the 3rd standard deviation Bollinger Band in red. And then we rallied and we went into a consolidation. What made things different is that while on this day here, while it looked as though, okay, we're going to have another failed rally, we're going to break the new lower lows, the market said, nah, we're going to break out. And now this time what we're going to do is we're going to go and we're going to put in higher lows and higher highs. We're going to pull back. We undercut support. We kind of held it. We rallied, pulled back, put in a double bottom setup. And this is where you want to really use your weekly chart, and it was off to the races. Let's take a look at the weekly chart from back in 2008 of what we might be looking at. There's 2 ways that this could play out. One is a W formation here, right? So on a daily chart, this is really a smoothing net mechanism of what we saw on a daily time frame. We rallied, put in the bottom here the week of November the 17th, 2008, rallied to a high of 2783 on the QQQ, even broke out, failed to hold it, rallied, declined more, and put in a higher low. Then what we did, and this is what set the fire underneath the market, is that this pivot point here at 2797 was where every single institutional eye was looking at. They wanted to know, did the market have the rocket fuel to get through 2797 and close there? If it did, it was off to the races, and that's exactly what happened. That was the end of the financial crisis. Fast forward to COVID. A different type of bottom, but a bottom nonetheless. But what was consistent is that we had a lot of false bullish flags. And each of these was probably incited by the Federal Reserve. Half basis point cut, quarter basis point cut. We're going to do this. We're going to have this new program, blah, 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 blah. And the market just said, yeah, but not enough. Yeah, but not enough. And they broke to new lower lows. And it wasn't until here where you had the government come out with massive, massive spending supported by the central bank. And this time here, you had a lot of congestion. You had a lot of indecision. And what I always like to say is we stop putting in lower closing lows. That's step 1 to a bottom. We stop doing that. There's a tug of war going on down here. So you don't want to do anything. You don't want to do anything. You don't want to interpret this. We're not that smart. And neither are the institutions. So what we were waiting for was a breakout above where you see these topping tails here. You got it. And then we dropped into a flag formation. Now, I want to say I was a guy that believed that this formation we're going to talk about happened. I want to say I didn't think it was going to happen. I was completely wrong on this formation. I thought that we would do a pullback and a retest like we saw back in 2007, 2008, like we saw back in 2000. This time around, it was a different animal. And I was wrong. I'm not going to come on and blow smoke up your butt. So let's take a look at it on a weekly chart to get a better feel of what it might look like. So what we looked at back here, back in 2008, was your W formation weekly time frame. What we saw back in 2020 was a V shape. We had an outside reversal bar the week of March the 23rd, and that was it. What the markets heard was that the government was backstopping everything. I didn't appreciate it because I was still hung up on the technicals. The markets didn't wait for the technicals. They just ran with it, and the rest is history. So that's what we're looking at now. So while Friday was a bloodbath, Thursday was a very bullish day. We don't know what we're looking at for this coming week. Don't be surprised if Thursday was a short-term bottom in the market. And when you take a look at sentiment indicators, sentiment is still very, very bearish historically on the market. That's a good thing. You never see a bear market end with a bullish market, a bullish sentiment in the marketplace. Everybody's bearish. And as a contrarian, that's what we want to see. The put call ratio, lots of puts being bought. So not a lot of bullishness out there. Skew index, same deal here. So we may get a rally in the market. We may not. I'm non-committal at this point. What's holding me up is that yields are still very strong. Let's take a look at what they're looking like in the pre-market. Yields are still holding a 4 handle. I went over this on Thursday night stock charts live. We're going to have resistance up at, the lights just went out in here, up at a 4 handle, 4.25. So I think that we're going to break out on the 10-year yield. That is not going to bode well for the triple Qs. The dollar is pulling back. Does it pull back further? Not quite sure. VIX is benign right now. We haven't seen a blow off top on the VIX, and that's what I would really like to see here. That's what's missing in the market, is that blow off top monthly view VIX. And we're threatening a breakout here. So I would love to say that we hit a bottom. I'm non-committal. I'm not going to be the least bit surprised, though, if we get a rally in this market due to seasonality factors. And if we get spending packages coming out of the government that find its way into productive areas of the economy and grow GDP. Now, if it's misallocated and that money goes to areas like they did under Obama, into companies that were green companies that went bankrupt, well, then you're going to be looking at more debt than you ever saw before, and a stagflationary economy that is going to make the 1970s look like nothing compared to what we're going to be looking at in the future. So let's talk about some chart requests. We'll take a look at some comments, and then I will say goodnight and look forward to another trading week. Let me see if I have anything in the members area. Go to comments for a minute. Falcon, TF Hatter. Yeah, no plunge protection team just yet. Hey, Bob, did you hear Yellen proposing buying long duration treasuries by the end of the month? I did hear something to that effect. Yes. She could have done it when they were at 1%, right? She could have done that, but she waited. That woman is so stupid. She had cash on her balance sheet. She had US dollars on her balance sheet. She spent the dollars rather than borrowing long at the end of the curve, borrowing for 30 years at 1%. In real terms, negative interest rates. And instead, she spent the cash. Now that yields have risen, now she wants to borrow long. Go figure. Wood fireplace is the way to go in the winter. Yeah, no doubt about it. I got to look into that, to be honest with you. Hash is a good economic indicator on their outlook. Okay. Crash the equities market to buy bonds. All right. Biden to ban import of aluminum. That's to really stick it to the Chinese because they've been dumping. Now is the time to buy CNX bind. CNX, a first request up for my main Caballero, Falcon. All right, so CNX, I'm in the same position you are. Correct me if I'm wrong. CNX is the railroad, right? Railroad company? Can you confirm that for me, please? Because we have a trade on Union Pacific right now. All right, so CNX, let's go to a monthly chart. I haven't looked at this one in a while. Folks, we're using TrendSpider, automated technical analysis. There's a 7-day free trial for them. Use the discount code below. 35% discount that I get, I'm giving to you. So take advantage of it. All right, so in a monthly time frame, you can't buy this right now. We're at monthly resistance. Weekly view. Again, more resistance above. What I'm going to do is I'm going to overlay monthly resistance on top of the weekly chart. You'll see the monthly resistance on a weekly chart in dash line. We got to get through 1759. Otherwise, it's not looking horrible. Oh, I see what happened here. Daily chart. Yeah, we broke down on Friday. Yeah. So yeah, I see where you're at. So what happened? I'll take these automated trend lines off. I'll throw them back on. So what happened here is that we broke out and above these, not one, but two resistance levels on Thursday on that reversal bar. And we gave it all up in one day on Friday. We did it on volume too. So there were sellers planning to sell strength in this. So yeah, I see where your bind is. But I would argue that if you like the stock longer term, let's go back to that monthly chart for a moment. You spent months trying to wear down the bears up here. You have a lot of overhead supply, apparently not enough buying volume to get through this. I think that what would be good is an orderly pullback, and then you get another running start at this resistance level and get the final sellers from up here out of the selling pool, and that'll give you the opportunity to break out. And once you close above 1880 on CNX, I think it's off to the races. I think it's going to move up higher. And next stop is probably up at a 24 handle on CNX. That's my take. We're long a boil, Trader Isaac, and it's pulled back to weekly support, but with natural gas down 3% in the pre-market, I'm not looking forward to boil tomorrow. You know, we're going to have covered calls that expire this week, but there's not a lot of money left on the bone there. So to finish off with Baba, I may buy the dip tomorrow on excuse me, not Baba, on Boyle. If they pull it back tomorrow morning at the open, if it doesn't recover, I'll probably buy that dip, add more to the position, and see whether or not we get a rally back. If we don't, then I'm going to have to take a portion of that position off the table. Baba. Okay, so this is a Chinese stock. For disclosure purposes, I do not buy Chinese stocks. I think that at some point in time, they're going to go the way of Russia, and you're not going to be able to trade them. So be very, very careful. Remember, we're in a war. And looking at the monthly chart, it is not looking good. We have made new, I don't know if this is historical lower lows or we have support below. I don't think that we do. It looks as though we're probably going a lot lower on BABA on a monthly time frame, assuming that we do not rebound. Now, support is going to be at $68 a share. Weekly view. Not looking good here. You can see that they bounced it off of this volume shelf, the lower band of the volume shelf in 10. It's probably going to break. Daily view. If you're looking to buy this for scalp, wait for a retest. We broke out on a daily time frame out of this declining downtrend channel. Broke out, we pulled back, retested back on the 11th. Then again on the 18th. No, it can't be the 18th. Is this right? It's not even this 18th yet. 12th, I guess. I can't see. This is a new monitor. I can't see the date clearly. But on Friday, the 13th, this is the 13th. Then on Friday, we did a reversal bar. Look for a retrace back down to, let's call it $79 a share. Where do we close? $69 a share, $69 a share, and see if it holds that level. It's difficult for me to read these numbers, so I apologize. I am not in my office. I'm in my dining room, and the setup here is horrible. What do you think of STX? STX. Seagate Technologies. Not loving it here. We're dropping back down into a long-term base. What it looks like, what we're doing is we're doing with Seagate Technologies that we're doing with pretty much every other company out there. We're retracing back down to the pre-COVID levels, and that's where we're going. So that's what I would anticipate on Seagate. We're right at the doorstep right now. So expect support at around $44 a share on Seagate Technologies. Daily view, not much happening here. Consolidating. I wouldn't buy it. I wouldn't short it. All right, what else do we have? Oh, CENX. Sorry about that. Oh, Century Aluminum. You know, when Trump put the tariffs on the Chinese, it didn't do a great deal for names like U.S. Steel. So I wouldn't want to fall into a trap of thinking that because they're going to do import bans, it's automatically going to be bullish for aluminum. Because I expected that back in Trump's term. And U.S. Steel was strong. It was really strong after COVID. But CNX looks very weak here. This is a monthly chart. RSI is stabilizing. Stokes are flatlining a bit. We are at support levels. That were last seen back in 2020. Without economic growth, I don't see the compelling reason to go buying CNX at this point in time. Let's go to a weekly chart. Maybe it'll change my mind a bit. RSI is looking good. Higher lows. I wouldn't be a buyer until we broke above $7 a share and closed there. Daily chart. Horrible price action. Thursday, nice breakout. Friday, bearish engulfing bar. I would avoid this. A lot of times what you think is going to be bullish for an equity doesn't turn out to be. So just be careful of that trap of protectionism. That's a double-edged sword. You're welcome, Falcon. Anytime. Tim, you're very welcome. Trader Isaac, CF. Wow. That's the daily chart. You have a lot of resistance above. At around 108. Support at 79. In between, if you want to cut the baby, $91 a share. We closed at 98 bucks a share. And this is where we're probably going. Because we have lower highs, and we're probably going to test this lower low here. Do we break it? I don't know. I'm not that smart. But if we do put in a higher low here, or we retest, we hold, and we break back out and above the highs of last week, then it's game on to the long side. If you want to nibble down here with a tight stop loss right below, fine. But I wouldn't get aggressively long until we rally up and through last week's highs and close there. We're going to leave it off with IEP. And I am going to take a painkiller and go to sleep. Icon Enterprises, my hero. Let me redo this. I want to make sure I get this right. Okay, yeah, that's better. All right, so what we're doing here is we have a very tight triangle formation forming. Mina, stop. I'm my dog over here. Mina, come here. And it looks as though on a monthly time frame, we want to break out. Daily view. New weekly higher high. Last week. Love the Stokes, weekly time frame. Loving the Stokes here. RSI, higher highs, higher lows. Good stuff. This is a stock that's building a base and is beginning to break out. Daily time frame. A ton of resistance immediately above. You got to close above 53 bucks a share. Game on, Icon Enterprises. And that's it, everybody. Everybody have an awesome night. TF. You're welcome, my friend. Seymour Rivers. You're very welcome. Thanks for being here. Thank you very much, everyone. I appreciate you being here. It humbles me. Thanks for listening to me. When you go off those meds, scale out. It's just like trading and less emotion. Okay. Thanks, Falcon. I appreciate it. Hey, folks, everybody have a profitable trading week. Stay small. Just watch. Don't listen to the thugs on CNBC. Watch. Just watch. Do we put in higher lows, higher highs, or do we break down to new lower lows? As long as you have your net liquidity, you're good. Don't get overweight the market. Be well.